Hello everyone, I hope so you will be fine. So guys, we are discussing today again the section is corporate finance section, and this section is 20% of your exam. Okay. And in this section, in corporate section, so we got these units. We got unit number 4, which we are discussing now. We have unit number 5, 6, 7, and 8. Okay. So here we go, types of securities, which is the title of unit number 4, which we are discussing in the last class. We started with the bonds, by the way. Okay, in bonds we discussed in the last class we discussed about introduction to the bonds. We also discussed about different types of bonds, advantages, disadvantages of the bonds to the issuers. Okay, so now we are continuing with this topic. So here we go. Today we will talk about mainly how to calculate the value of bonds. Okay, that's more important from calculation point of view. So I'm moving to that area. So here we go. First, starting with bonds valuation. Okay, guys, I just want to tell you here because as a company, if you are issuing bonds, okay, so you need to know that what price you should receive from the investor. Okay, so which is also called, it means if in your exam question, if he will ask you these things, if he will ask you to calculate the market value of a bond, so you will do the same calculation which I will show you. If he will ask you the issue price of the bonds, again you will do the same calculations for this also. If he will ask you to calculate the cash proceed, okay, through the issuance of bonds, so then again you will also do the same calculation. Or even if he will ask you to calculate the present value of cash flows associated with the bonds, so again you will do the same calculation. Even if he will ask you to calculate the amount of premium on issuance of bonds or amount of discount, okay, so you will do the same calculation. So please bear in your minds, so all these terminologies represents the same types of calculation. Okay, so here we go. Now, what we are discussing here, like how to calculate the market value of bonds, or how to calculate the issue price, or cash proceeds, or present value of cash flows associated with the bonds, or amount of premium or discount. So before moving to that, so as a company, so you have to think from issuer point of view. Issuer mean to say the company, okay, definitely that is going to issue the bonds. So it's very common and crucial question for the issuers, that what price I should charge from the investors. Okay. Okay, so that's called what the issue price. The how issue price is decided, okay, from issuer point of view. So the issuer, what you will do, the first thing, he will compare two rates. He will compare the stated rate, and he will compare the stated rate with the market rate, and then according to that he will take the decision. Okay, so here we go. So what is stated rate first? We need to understand. Stated rate actually is the simply rate of interest which is mentioned on the bond. Okay, it is also called coupon rate. Stated rate, coupon rate, or interest rate. So I would say these are all the same things. So this is what is the rate which is mentioned on the bond, as I have told you. Now, what is the market rate? Market rate, please remember here, market rate means say whatever the required rate of return is prevailing in the market. Okay, like how much investor is demanding, for example. So that's called market rate. So market rate could be written as yield to maturity also. Okay, yield to maturity. So yield to maturity means like as an investor, if you will hold the bonds until its maturity date, maybe let's assume if bond is having a life of 5 years, if you will hold this bonds for the 5 years, and every year you will receive interest plus at the end of the bond, if you will receive the original amount or the face amount, okay, so what return you will get in terms of percentage, that's called yield to maturity. And we are assuming market rate and yield to maturity is equal here. Okay, this is the assumption. Generally, when we calculate the yield to maturity, we calculate internal rate of return from bondholder point of view, but that is not our part here. So we are just discussing how to do the bonds valuation. Okay, so I told you stated rate, which is mentioned on the bond, and the market rate, whatever the rate of interest is prevailing in the market. So once you will compare these two rates, it will help you to decide should we issue the bonds at par, at premium, or at discount. So here we go. I'm starting from here. For example, if stated rate is 10%, mean to say the rate of interest which is mentioned on the bond is 10%, it is exactly equal the rate of interest, okay, in the market. For example, in the market rate is also 10%. If both the rates are exactly equal, so in that scenario the bonds will be issued at par value. Par value is also called face value. Face value is also known as nominal value. Okay, so this is the first thing. Second scenario is if your stated rate, for example, is 10% and in the market rate is 8%. Like in the market rate of interest which is required by investor, for example, it is 8%, but you are paying 10%. It means we can say this scenario this way, that stated rate is greater than market rate. Or we can say the market rate is lesser than the stated rate. So in that this scenario, bonds will always issued at premium. Okay, now the question is that why premium? Okay, why premium? I will tell you. For example, you should think this way, because in the market, for example, people are demanding 8%, but you are offering 10%. You will pay 10%, but their demand is 8%. So now it means you are paying more than their demand. So that is why if you are paying more than their demand, so today you got a right to receive more money than face value. So the bonds will be issued at premium. So premium mean to say what? Premium means say what? The issue price is going to be greater than what? Greater than the face value. That's called the premium. Whenever for example, if face value is $1,000, but you are issuing bonds at $1,050, so $50 is known as premium. Then third scenario. Okay, the third scenario is, so if let's assume stated rate is 10%, which is written on the bonds, and it is less, it is lower, it is, let's assume, lesser than, lower than what? For example, market rate. In market, for example, rate of interest is 12%. So see what's happening here now. So first you should know that CN is what? The bonds will be issued at discount. Okay, now the question is that why? Because in market people are demanding, let's assume, 12%. So but you are offering 10%. So it means if you are paying, which is 10% less, lower than the market rate, so today you should receive lower than the face value. So discount mean to say here issue price, IP stand for issue price, is going to be lower than what? Than face value. Okay, now you can understand the scenario number one also. If exactly you are paying as per the market rate, so then bonds will be issued at par. So these three scenarios you should remember, because sometime in a theoretical questions he can ask you, should we issue bonds at face par, sorry, face value, which is also par value, or should we issue bonds at premium or discount? So I told you very quick way to decide. Now you have to remember one more thing. When you compare the stated rate with the market rate, okay, to decide the issue price, should it be par value, premium, or discount? Okay, so this, when you are doing this actually, definitely at the time of issue you are deciding this. So for example, if I'm issuing bonds today, or maybe I'm trying to issue bonds within a week, so I'll check, okay, what I'm offering, what the rate is prevailing right now in the market. At that time I will compare and I'll decide according to that. Okay, and this method, when we compare the stated rate with the market rate, okay, this method is also called effective interest method. Okay, effective interest method actually we will use, okay, to calculate the values, like what should be the amount of premium or discount. Okay, so how we will do that I will explain, don't worry. Okay, so now guys, the next question which we need to understand, so how you will decide again the amount of premium or discount. So here we go. I'm just going to show you here small calculations. This is the decision, okay, at the time of issuance of bonds, how you will decide. So simply guys, so what you will do, you will calculate the present value of bonds. Okay, but before that, let me tell you one basic simple thing. The simple thing is that before moving even to the present values, I just trying to explain a basic concepts. In finance, when you value any investment, okay, whenever you calculate the value of investment, how you do it. Actually, you always consider the future cash flows from that investment. I can give you example. For example, if you are planning to buy a building, okay, what I said initially, I said value of investment is dependent upon future cash flows. Okay. For example, uh, I'm giving you example. Let's assume if you are planning to buy a building, let's assume, and you got two options. One building is in maybe in the middle of the city, and other building is in the desert. Now, if I will ask you which building is going to have higher value, market value, so definitely your answer would be the building which is located in the middle of city. So that is going to have a higher value. The question is why. Now you need to think why the building which is located in the middle of city is having more value. The reason is that because you as an investor think this way, okay, if I'll buy this building, okay, this building can give you more rental income if you will rent it out. But if you will buy the same building, similar infrastructure in the desert, but maybe their rent could be lower, right? So here you expect that rental income could be higher if you will buy the building which is located in the city. So it means why you said the value of the building is higher. So because the future cash flows for the building which is located in the mid of city is more, right? So we expect more cash flows. Now the question is that what I'm trying to say. So if you want to value any investment, what we consider value is always dependent upon future cash flows associated to that investment. Okay. Now you need to think this way. If you want value today, like if you want the value of an investment today, what you will do. So again, I'm writing here. So value of investment, okay, how you will calculate. So simply you will calculate the present value of future cash flows. So if future cash flows, you will discount and you will convert back to the present value. If you will convert back to the present value, so this is going to be the market value or the value. Market value or simply the present value. It's the same thing because when we calculate present value of anything of future cash flows, it means that is going to be the market value in today's terms. Okay. Now we have to continue this step here. Okay. So what I said, so value of investment is dependent upon future cash flows. And if you want to calculate the value today, you need to calculate what you need to calculate the present value of those future cash flows. Now the question is that now let's relate this information with the bonds. If you are calculating market value today, so it means I need to calculate the present value of future cash flows associated with the bonds. This is what associated with bonds. This is what we learned now. Okay. Now the question is that how many types of future cash flows are there which are related to the bond. So there are mainly two types of future cash flows. You should think from investor point of view or from company point of view, from any point of view you can think, because as an investor you will receive these two cash flows, and as a company the company will pay these two cash flows. Okay, now the question is that how much cash flow, which cash flows. Number one, the first, if you're thinking from company point of view, I would say this way now, that the first cash flow which the company will pay, that is going to be the interest. It could be a per annum or it could be a semi-annual. Okay, so first we will pay the interest. In short, we will pay the interest, okay, over the bond's life. For example, if bond life is 5 years and interest is payable annually, so it means 5 times I will pay interest in a 5 years period, right? If interest is paid semi-annually, means after every 6 months, then in 5 years I will pay the interest 10 times. So but the point is the interest is going to be the first cash flow which is relevant to this bond. Second is what? The face value. Because at the end, okay, the company will return the money, okay, back to the investors. We will return money to the investors, right, at the end. So that's the face value which we will return. We assume we return face value. Okay. Now if you will think from investor point of view, it means as an investor you are going to receive interest, and you are going to receive face value at the end of the maturity period. Okay, so now if I will calculate the present value of interest and present value of face value, if I will add these two figures, so this is going to be the present value of future cash flows. And this present value future cash flows is going to be the market value of investment. Okay, or I told you the if we will ask you calculate the market value or issue price, okay, or maybe the present value, it's the same thing as I told you right earlier. So what I told you, simply we need to calculate the present value of interest and face value, okay, and that is going to be the issue price or that is going to be the market value. Now we have again one more question, how we will calculate the present value. I'm not going to explain here time value of money concept. No, I'm just going to do the required things which are required. If even if you don't know the time value of money concept, so simply you can follow this format to solve your questions. So here we go. I'm just solving it. So it means first of all, now if I'll move to the bonds, so first of all, we need to calculate what present values. I'm just writing here. So it means we have to calculate present value of two things. Number one, we have to calculate the present value of interest. How I will calculate? First of all, I need to calculate the interest figure. Interest, you know how you will calculate always, I have explained in the last class. You need face value of bonds multiply by stated rate. Don't multiply here market rate. No. So this will give you the interest figure in dollar. This is what I need. Okay. Interest in dollars I want. Okay, dollars figures of interest. So how I will calculate face value, don't take it as a fair value, no, face value, which is par value, time stated rate. Don't multiply here with the market rate, I'm telling you, because this is what is the actual interest you will pay, which is mentioned on the bond. So we will take interest times, now here we will multiply here, you will multiply this interest percentage with annuity factor. Which factor? Annuity factor. But when you select annuity factor, you will take annuity factor at market rate, because we are comparing our stated rate with the market rate, okay, to find out the present values. So here is very important note, I'm just highlighting. When you use here interest calculation, you will multiply with the stated rate, but when you will pick the annuity factor, you will use the market rate. Okay, let's assume here, for example, stated rate, I'm assuming, let's assume it is 3%, market rate is 10%, 5%, for example. Okay, now the question is that how, from where you will get the annuity factor. Even as I told you, if you don't know time value of money concept, so just you can follow these steps. Okay, annuity factor from where you will get. So I'll show you these tables now. So these tables will be given in your exam. Okay, this present value table, see, look at the heading. This is written as present value of ordinary annuity. Okay, annuity word is here. Okay, from this table you will select. There is another table which is known as present value of $1 table. No, we don't need $1 table here. We need here annuity table. So we'll go to the annuity table. For example, if market rate, how much I have assumed, I'm not sure. We have assumed 5%. Okay, and I'm assuming bond life is 10 years. So what I will do, I will go to the table, I'll go to the 5% row and I will go for the 10 years. For example, look at here. If you will look this table, on the top of the table, you can see the percentages are written here, right? Okay. And if you will look vertically, you can see here number of periods are written. So what I need for at 5% for 10 years. It means which value I will pick? This value I will pick. So this 7.722 is your annuity factor, and this is what you will multiply with the interest. Okay, so whatever the interest figure you will get here, for example, $80 times whatever the annuity factor was there. So this will give you one present value. Is that clear? Okay. Now, second thing, what you need? Second thing you need present value of face value. So what we will do, how you will do? You need a face value. Okay. Here, guys, you also need to remember one thing. If you're using your interest of one bond, so you should use your face value of one bond. But if you're using a total interest, so you should use a total face value. Okay. This, like with like you have to do. Okay, face value of the bonds we will take, which will be given to you in the question. And now this face value of the bonds, definitely it will be in dollar. We will multiply with what? We will multiply with the discount factor. It's also called present value factor. But this discount factor, you will look again at market rate. I'm highlighting at market rate. But from which table? I'm mentioning the table here also. You will look here the present value of $1 table. This is what you will refer here. But for the above, you will refer here present value of ordinary annuity table. Present value of ordinary annuity table. Okay, these are the headings of the table actually. So when you are taking interest, go to the annuity table. But when you are using face value, go to the present value of $1 tables. I'll show you here. Okay, present value of $1 table. So present value of double again, I'm assuming my market rate is 5%, bond life is 10 years. So I'll go to the table and look at the heading first. The heading is present value of $1 table. Okay, again, you will go to the 5% for 10 periods. So which value you will pick now? This value you will pick 0.641. So this figure 0.641 you will multiply with what? With the face value, and you will get another value. Okay, now if you look at it in this format, we got two things. We got present value of interest also. We got present value of face value also. Now what we will do, we will make the summation of these two figure. We will add these two figure. So this is called what? This is called market value of bonds. If he's asking to calculate, this is the answer. This is called issue price also. This is called present value also, present value of cash flows, future cash flows. Okay, I hope so it is clear, right? This is called cash proceed also. Actually, this is the answer for that. Okay, but the question is, if he is asking to calculate the amount of premium or discount, so then you do one extra step. Extra step is what? So this figure, you are going to compare this figure. Okay, you are going to compare this figure. You are going to with compare with what? You are going to compare with total, with the face value, with the face value. Because I told you rule, if you use interest here for one bond, you should use face value of one bond. So it will give you present value of one bond, or market value of one bond, or issue price of one bond. And if it is one bond, so then you have to take care face value per bond also when you compare. If it is total, like for example, if you have used total interest, total face value, this is total value bonds, then you should take it here total face value. Okay, like with like. So what you are going to do now, so you are going to compare this market value bonds with the face value. Okay, face value will be given to you. You don't need to do calculation for that. Okay, so you will compare with it. Now you have to decide. What you have to decide? You have to decide. Rule is very simple. If this figure is greater than this figure, in simple, if present values are greater than face value, so this is called amount of premium. The difference is premium. Okay, okay, but if the present values are lower than face value, this is called amount of discount. And don't forget, this is going to be your issue price. If this price is bigger, so it is premium. If this price is smaller than face, it is discount. Sometime, sometime this present values could be exactly equal to the face value. Okay, so it means there is no premium, no discount. Now you need to understand here, when this situation will arise, when premium will arise, whenever stated rate will be greater than the market rate. I told you earlier at the start. And when discount situation will arise, so whenever stated rate will be lower than market rate. Okay, so when this situation will arise, when present value will be equal to the face value, so when if so here, if present value equals to the face value, it means bonds are being issued at par. So when this situation will arise, when stated rate will be exactly equal to the market rate. Okay, so this will happen this way. So this is how you will calculate the market value of bonds, or even amount of premium or discount. Is that clear? Any questions so far? Okay, because now I'm going to do some couple of questions. Okay, first I'll start with how you will deal with the annual interest, and then I will also do a couple of one questions for how you will deal with the you know, I mean to say, with the semi-annual interest. Okay, two scenarios I'll explain. Okay, now here we go. Let's have a look. We are going back to the question here. Now, actually, we are starting the question. So whatever scenario, I will not tell you first. First, let's read the question and see, is it discount, premium, what? Okay, so here we go. Question is on your screen. So question is what they're saying, that an entity issues 200. Can you see, is there any dollar sign attached with the 200? No. So it means these are number of bonds. Number of bonds, like 200 bonds. 6%, the which 6% is written here, this is actually the stated rate which is mentioned on the bonds, because this information is available with the bonds. So they're saying an entity issues 200, it means 200 bonds. 6% is a stated rate. 5 years means a maturity period. Maturity period or bond life, in simple word, it's called maturity period also, or bond life, or bonds term also. Okay, bond terms 5 years. Okay, then what is this 5,000 bonds? Okay, 5,000 bonds. Actually, because here numbers are given separately, so we will assume this is the face value of one bond. Okay, face value one bond. Sometimes he may give you directly 1 million bonds. It means it's a total value. But if he told you number of bonds, then we will assume this is the face value per bond. When prevailing interest rate in the market is 8%, okay, that's your market rate. Now, before moving further, I can solve the question here, because I have all the required things which I need to calculate the value of the bond. Now the question is how the bond is going to be issued at par or premium. So I have already told you. So you will compare two things. You will compare two things. Which two things? The stated rate, which is given here at 6%, and the market rate, which is given here at it's 8%. I told you whenever your stated rate is lower than market rate, bonds are issued at discount. For example, stated rate is 6%, market rate is 8%, so bonds are going to be issued at discount. Okay, now we also assume here what we assume here, we assume that this is the assumption. Okay, uh, we assume that this interest is paid annually, because this point you also need to know, interest is annually paid or semi-annually paid. Because if semi-annual paid, so we need to adjust our calculations according to that. So this question, whatever I'm solving, I'm assuming interest is paid annually. Annually means say once in a year. Okay, annually. So I'm putting here interest payment, interest we are paying annually. Interest is paid annually. Okay, this is what is the question, because in the question he will clearly state this statement, so that interest is paid annually or semi-annually. Semi-annual means say twice a year, but here I'm assuming it's annual. So we what calculations I'm explaining, it's from annual point of view. Now please, here we go, have a look here how you will work now. So first of all, do you remember I told you the format? I told you first you need to calculate the interest figures. Interest, because you need present value of two things. Present value of, you need interest and the face value. Okay, so I told you, if you will use interest of one bond, then you should use face value of one bond, or if you will use total interest, you should use the total face value. So I'm using total here. It's easy. So here we go. First of all, interest, how I will calculate. Let me remove this. How you will calculate the interest first. Okay, interest in total I'm calculating. So how you will take number of bonds, multiply by face value per bond. This will give you total face value. Total face value. For example, number of bonds in the question 200. Face value per bond is 5,000. If you'll multiply, so total face value is going to be $1 million. Okay. So once I got the total face value, do you remember I told you total face value you need to multiply with the stated rate. And what's the stated rate? 6%. So once you will take face value times stated rate, this is going to give you interest figures, interest figure, like interest amount. And interest amount is going to be how much? Interest amount is going to be, if I will take it, so it is going to be 60,000. So this is what is the interest. Now here we go. So now we will take here interest figure, interest I'm dealing first. We will take 60,000. And if you remember, I told you interest you will always multiply in the format. I told you interest you will always multiply with the annuity factor. This is the annuity factor. Now the question is that annuity factor, how you will choose. I told you rule, you will look what is the market rate. So market rate is 8% given the question, and then you need to look the bonds life. Bond life is 5 years. It means I'll go to the annuity table. I will look for 8% and 5 years. Here we go. 8% and 5 years. Annuity table 8% and 5 years. So this is the annuity table. Okay. So this is the annuity table. So 8 is the market rate for 5 years I'm looking for. So which value I will pick? I will pick this figure 3.933. Okay. So 3.933 you can look at here. It's written 5 decimal places. Okay, 3.99271. Okay, so whatever figure is given in the table, just use that one. So because here he used up to 5 decimals, that's fine. So we will multiply with it. Okay. So now this will give you present value of interest. Interest matter is solved. Now what? I told you you need a present value, face value also. So face value is already, we have already calculated here, right? So we'll use that one face value, which is 1 million multiply by, I told you multiply by discount factor. But this discount factor again, make sure you will find in $1 table. Okay. So $1 table again, you will go to 8%, go to $1 table, look for the market rate, which is 8% and 5 years life. So see the factor here. So we will go to again next sheet. So here we got a $1 table. I will look at 8% for 5 years. So this is the 5 years. This figure I will pick now. 0.681. So this is what is being multiplied here. Okay, 0.6805 because it's written up to 5 decimal. No problem. You can use whatever the figure is available in table. So now 1 million you will multiply with it. So this will give you present value of the face value. Clear? Now what you are going to add? These two figures. So look at here. So this the issue price or cash proceed from the bonds or the issue price is going to be 920,143. Question is solved because we were required to calculate the market value. But the question is, if he will ask you what is the amount of premium or discount. So this figure you will compare, this figure you will compare with the par value or with the face value. And face value we have already calculated 1 million. So the difference is going to be the discount figure. See, this figure is lower than face, right? So this is going to be the difference is going to be the discount. Okay, guys, I hope it is clear. Any questions so far? Okay, so we are going to do another question see here, and then we will see the scenario. It is premium, discount, whatever. Let's read the question. They're saying that another example, similar kind of questions will appear in your exam. Okay, but again here I'm assuming interest is paid annually because then one question I will do with semi-annual interest also. So here I'm assuming interest is paid annually, so I'm putting here annual interest. Okay, so let's have a question. They're saying an entity issues 200 bonds. Again, these are number of bonds. Number of bonds. 8% is the stated rate. 5 year is the maturity period or bond's life. 5,000 bond means it's a face value one bond. It's a face value one bond. When prevailing interest rate in the market is 8%. Okay. So again, I need this information only to find out the market value. So how you will do it again? First of all, you need to calculate the interest. And interest, how you will calculate? First, find the face value, total face value. So total face value, how you will calculate? Number of bonds times face value per bond. Okay, like the number of bonds 200, face value per bond is 5,000. So total face value is going to be 1 million. And now this 1 million you will multiply. Okay, listen me, you will multiply with the stated rate to get the interest. Stated rate is going to be 8%. It's given here 8%. If you will just take, it is going to be 80,000 interest in dollar 80,000. So this is what is written here, 80,000. I told you interest you will always multiply with the annuity factor. But when you select the annuity factor, you need to look what is the market rate. So market rate is now 6%. And you need to look for the bonds life. Bond life is 5 years. Bond life is 5 years. So you will go annuity factor because we need the annuity factor. You will go to annuity table, look for 6% 5 years. I'll show you. Annuity 6% 5 years. So this is the annuity 6% for 5 years. This is a fifth year value. Okay. For year five, this is the value. How much? 6% 5 years. This is the value 4.212. Okay. This figure you will multiply here. A 4.212 with the interest. This will give you one present value of interest. Then you already have the total face value. This is what we are writing here. Face value now 1 million times. This face value you need to multiply with $1 figure. You know $1 table, you will go to the table. Again, look for 6% 5 years. Go to the table. $1 table. 6% for 5 years. So this is a figure which is something 0.747. Okay. So here we go. So here it is multiplied a 0.747 with this face value. You got another present value. Okay. So if you will add these two figure, okay, if you will add these two figure, this is going to be total market value. Total market value, okay, or cash proceeds or market value. Okay. Now you look here, the market value is more than 1 million. So if you want to calculate the premium or discount, just compare it with the face value, and face value is 1 million. Okay, definitely the difference is going to be the premium now because this figure is bigger than face. So it's going to be premium. Okay, great. Now the question is that our calculations are correct or not? Yes, it is correct because if stated rate is greater than market rate, so this will result in premium, and you have noticed here. So stated rate is 8% given in the question here. Market rate is now 6%. So definitely the difference is going to be a premium. It should be issued at premium, and we got a premium in calculation. Clear, guys? Any questions so far? So we learned how to calculate market value of the bonds, even amount of premium or discount. Okay. So this is what is the format. If you have any question, please ask. Okay. Now, guys, sometime. Okay. There's another way. One way I told you that bonds are how to calculate the amount of premium or discount. Sometime there is another way which can be used in your exam question also. The other way is that like this. For example, he can tell you bonds are issued at 97. So what it means? 97 means what? It's not $97. Okay, so what it means, how then in this scenario, if he told you, because this is another way to find out issue price if data is given like that. So if bonds are issued at 97, what it means, how you will calculate the issue price? So issue price will be calculated this way now. So how you will take the face value of bond, face value of one bond times 97%. Actually, this is 97%. For example, its face value of bond is $1,000 times 97%. So this is going to be the issue price $970. Okay, there's another way he can, for example, if bonds are being issued at 102, 102. So it means what? So now how you will calculate the issue price? You need issue price equals face value bonds time 102% times 102%. Okay, so 97 now how you will calculate? So again 1000 if the face value bonds times 102%. Okay, so then you will get whatever 1020, so whatever, so you will get, so that is going to be the issue price. So please remember, if it is written less than 100 figure, for example 98, 96, it means bonds are being issued at discount. If figures are written more than 100 like 101, 102, or maybe 106, it means bonds are being issued at this at premium. Okay, if exactly it's written bonds are being issued at 100, it means bonds are being issued at par exactly. Okay, guys, I hope so it is clear. Done. So this is what the point I have already explained this point also. Clear? Any question? Okay. So we got here one question here. Simple question. Then I'll show you the calculations how you will deal with semi-annual bonds. Like if interest is being paid semi-annually, so how you will do the calculations, which things you need to change or adjust. So here we got a question here, guys. The first question, very basic theoretical question. Then I'll show you semi-annual calculations. So they're saying if $1,000 bond, means the face value is $1,000, sells for 1,125. Definitely here, if face value is 1,000, it's being issued at, issue price is 1,125. So bonds are being issued at premium then, right? This is what sells for 1,125, which is the following statement are true. So what? The market rate, whenever I told you, if the premium, when premium will arise, when stated rate will be greater than market rate, so that's in that scenario premium will arise, because this is the scenario premium. So now the statement number one, the market rate of interest is greater than coupon rate. No, stated rate is greater than market rate, so this is not a correct statement. The coupon rate on the bond is greater than market rate. Yes, this is the correct statement, which is true. Third, the coupon rate and market rate is equal. No. The bond sells at premium. Yes, as I told you, whenever issue price is more than face value or the present value, so that is going to be the premium. Okay. The bond sells at discount. No. So it means which two statements are correct? Only statement number two and statement number four are correct. So if you just look at the answer two and four, two and four, two and four. So state option A is correct. Okay. Now here I have a question. Okay, in this question we are going to work because uh, the exam questions can include semi-annual calculations also. So let's read this question and I will tell you what you need to adjust while you are dealing with the semi-annual bonds. Okay. So for example, they're saying young company issues $800,000 of 10% bonds. Now look at it, these are $800,000. Definitely it would not be the face value of one bond. It's a total face value. Okay, 10% bonds, it's a stated rate. Okay, this is the total face value. We got a stated rate of 10%, dated January 1, year 1. Okay. Interest is payable semi-annually. You can see here when interest is being paid on June 30 and December 31st, like after 6 months, interest is being paid after every 6 months. So bond matures in 5 years. This is the bond's life, 5 years life. Okay, the current market rate of for similar bond is 8%. This is the market rate, 8%. And definitely whenever you can see here stated rate 10, market rate is 8, so bonds will be issued at premium, definitely, because stated rate is more. Okay, But here the question, and then next what he told you, the following figures are given. He told you a present value of annuity. These are C annuity factors. These are present value of dollar one. Okay, present value factors given here. You don't need to consult the table. Okay, now the question is here, what you need to do. So they are saying what amount of proceed on sale of bond should Young report. Simply you are required to calculate cash proceed. Okay, so guys, please remember here, whenever you got a semi-annual payments, so you need to adjust three things minimum. Number one, you have, because these interests are always quoted annually, but we are paying semi-annual. So now what you will do, so please listen me what I'm doing now. Okay. So what we will do now, guys, we will adjust three things. Number one, what we will adjust three things. I told you, adjust three things first. Which three things you have to adjust? Adjust the market rate, adjust the stated rate, and adjust the life, because interest is paid annually. So market rate is how much? Just go to the question. Market rate is 8%. So you will do what? So 8% is annual rate. So you will multiply with 6 by 12, because 6 month interest is being paid. Okay. So this will give you half interest 4%. Then stated rate, or simply you can, if you don't want to multiply 6 by 12, just divide with the 2, because if interest is paid twice, so divide with the 2. Then stated rate, which is 10% given, divide with the 2 also, or multiply with the 6 over 12. It's up to you. It is going to be a 5%. Life is 5 years. Okay, but interest will be paid twice a year. It means 5 times 2. Don't divide it 2. Now here multiply, because 10 times interest will be paid in 5 years. So adjust these three things now. Now this information is relevant for you. Okay, forget about this 8% now, 10% and 5 years. Now this is the relevant. It means now market rate will become relevant for you. 4%, stated rate will become 5%, and life will become 10 times. Okay, 10 periods. Okay, 10 times or 10 periods. So this is what is important now. Now what you will do, you will calculate. Now I'm solving the question. You will calculate now, because we are required to calculate the cash proceed or simply present value of. First you have to calculate the present value of interest. Find out the interest first. Face value is 800,000. Stated rate, this is the stated rate you will use 5%. This will give you interest amount. Okay, you know interest formula, face value times interest, stated rate. So if I will take 800,000 times 5%, it is going to be 40,000. Okay, it is going to be 40,000. This is the interest. Now, this interest you need to multiply with the annuity factor, because we have to calculate the present value. Annuity factor, how you will select? Annuity factor, you have to look at 4%. Let me highlight, because market rate is 4% and periods are 10. So you will go to the table. This look at here. N means the number of periods 10, market rate is 4%. So this is the annuity factor. You will pick this value. Multiply by 8.1109. Multiply by 8.1109. Okay, that's the figure you will use. Is it clear? Okay, then what? So you will find the one value. Let's find it. So if you will multiply simply 40,000 with this figure, 40,000 times 8.1109, so it is going to be 324436. Then you have to calculate the present value of face value also. Face value is, this is the value, $800,000 times $1 present value factor. $1 you have to take. $1. Go to the $1 column. $1. Here we have a $1. Okay, and again, and market rate is 4% and 10. So this figure you will pick 0.67556. 0.67556. Just multiply, you will get another figure. Okay, just multiply this figure with this. So it is 800,000 times 0.67556. So you will get 540,448. Now add these two figures. This is going to be the answer. Add these two figures. So plus 324,436. So it is going to be 864,884. That's your answer. Okay, and this answer is going to be which option? B option. Okay, this is how you will deal with the semi-annual. I hope so it is clear. Okay, we learned how to calculate market value of bonds annually and semi-annually. So now I'm going to go through some other topics. Bonds valuation is over, guys. So now we have something important also to discuss, and this concept is called now interest rates we are talking about, and the concept is called term structure of interest rate. This is what I'm going to tell you. Okay, term structure of interest rate is what? Actually, guys, in this idea, what we are going to learn, we are going to learn how companies decide, okay, should we issue long-term bonds or short-term bonds? This is from company point of view. Even from investor point of view, how they decide should they invest in short-term bonds or long-term bonds. Definitely, guys, you have to clear it one thing in your mind that companies they always want to pay low interest. They will always go for the option with the low interest because they are paying, and investors they always want to earn more interest, so they will always go for the higher interest option, like where they can get higher interest, right? So this decision, how we can learn, so we can learn through the concept of term structure of interest rate. Actually, what is the term structure of the interest rate? Actually, it is going to be a relationship. By the way, this decision you can take from the graph. Just I'll show you that graph. Don't worry. Okay. So actually, the term structure of the interest rate. If someone will ask you what is the term structure of interest rate, you would say it is a relationship between yield to maturity. I told you yield to maturity means say like if you will hold the bonds for entire life of the over the duration of the bonds, how much return you will expect, how much return you earn. That is actually yield to maturity. Okay. Not expect how much return you earn. That is yield to maturity. Like simply yield to maturity means a return percentage. Okay, so and the time to maturity. Time to maturity means the duration of the bonds. In finance, this is a very famous statement. We say, okay, if maturity period is longer, generally interest rates are higher. If maturity period is shorter, generally interest rates are lower. But in term structure interest rate, okay, what I'm trying to say, we are trying to predict a relationship. Okay, it's actually a relationship between yield to maturity and time to maturity. Okay, now I told you this yield to maturity is the graph. Actually, you can look at here, this graph. This is yield to maturity graph. It's also called yield curve. Okay, yield curve. This yield curve will help you because don't leave the basics. Basic is should we issue as a company long-term bonds or short-term bonds? I told you company want to pay lower interest, so they will decide according to that. And investors also they need decision should they buy long-term or short-term because they want to earn more interest. Okay. So now the question is that how we decide. So we decide this through the yield curve. Now the question is this yield curve, this graph, who prepares? So this graph can be prepared and it is available on the internet, and there are a lot of companies which from where you can get this data. Okay, so this data you can get from Federal Reserve Board, central banks in other countries also. Even we have some financial data providers like Bloomberg, Routers, Refinitiv, IC Data Services. So many companies are there. Even rating agencies like Moody's, okay, Standard and Poor's, etc. So this curve is available on internet. You don't need to worry. But as a student, what you need to know, you need to know if this graph is in front of you, how would you interpret? That is the most important thing. How would you interpret? So here we go. If look at this graph, on one side it's written interest rates, on the other side it's written yield to maturity. I told you a term structure of interest rate. So it is a relationship between interest rates and years to maturity. Interest rate mean to say yield to maturity. Okay, and here these are years to maturity means a duration. So now look at here. If guys, for example, let me explain simple way. If you will moving from this is the origin. For example, if you are moving to the right side, it means as you are moving further it means years to maturity is are increasing. If you are moving from this, origin to this side, it means interest rate is also increasing. If you're moving this way, interest rate is decreasing. You know this, right? Okay, now the question is, how would you interpret this graph, these lines? Sometimes lines is are shown like that. Line A. This line is called, in terms, it is called upward sloping. If line is upward sloping, you know what it means. Look at here. Look at here. What it means. If line is upward sloping, so this line, I'm just naming it, it's called what? Upward sloping. Point number one, upward sloping. Okay. If yield curve line is upward sloping, so what it means? So interpretation is written there, but I'm just showing you. For example, if you're standing at this point, it means years of maturities are here and interest rates are here. If you're standing at this point, it means interest rate is here and years to maturity is here. So see, as you're moving further, so interest rates are becoming higher, years to maturity is becoming longer. So what it means here, if line is upward sloping, this is what is the meaning of upward sloping line. The meaning is long term interest rates are higher than short term interest rates. Long term interest rates are higher than short term interest rate. Now think, because in exam he may ask you, you are investor, where you will invest? Investors will always, if you are an investor and slope and the line is upward sloping, if you're investors, you will always look for higher return, high interest. And if you are a company or issuer, that you are issuing bonds, so you will always look for low interest. Now look at here, if line is upward sloping, so the as an investor, you, because long term interest rates are higher, so as an investor this will be your choice. You will always invest in long term securities. Okay, but if you are a company, you want to issue the security, so then you will not issue long term security because interest rates are higher, so you will prefer short term bonds to issue. Okay, because investor wants high interest, company or issuer wants low interest. So investor will choose long-term bonds to invest, company will choose short-term bonds to issue. This is what is mean if it is upward sloping. Now look at the next line. Okay, now the next line is, if it is this line, I'm explaining line number two, it's a flat. Okay, this is called what? In finance it is called flat. Flat means what? See, even flat means what? Even as you are at this point, so interest rate is here, maturity is here. Even you are at this point, interest rate is here, maturity is here. So see, it means it has no difference between long term and short term, right? So what you are going to do now, so if line is flat, so it means long term interest rates are equal to the short term. So now it doesn't matter, as a company you can issue either long term, short term, because same interest rates are there. As an investor, it doesn't matter, again you can invest in the long term or short term, on that's your choice. Okay, now the third is, if you look at the third line, the third line is downward sloping. That's the third line. Third line, if this is the line downward sloping, this third line, this is downward sloping. Like for example, if you are standing at this point, it means interest rates are here, maturity is here. If you're standing at this point, it means interest rates are here, maturity is here. It's opposite to the upward sloping totally. So here downward sloping means what? Long term rates are lower than short term rates. Now as an investor, what is better? You want to earn high interest. Long term rates are lower, so investor will go for the short term investments now. This is for investors, because he want to earn high interest. And the company, what they will do, they will issue long term bonds because they want to pay low interest. Okay, that would be your decision. And now the fourth line is fourth line is what is about, if you look at here, just go back to the graph. This is the fourth line now. Okay, line number four, this one, this is like, you can see here, it's like a humped. Okay, it's called humped line. Here short term, because maturity is here. Here is this point, it shows long term. So look at it, so short term interest and long term interest are lower, but in the medium, in the mid duration, the interest rates are higher. So in that scenario, what you will do? Okay, so if the slope is humped, so intermediate term rates are higher than other rates. Other rates means say short and long term. So intermediate rates are higher. So what you will do now, now as a company, because company want to pay low interest, company got two options. Either they can issue short-term bonds or the long-term bonds because interest is lower. But as an investor, you want to earn high interest. So you will not invest in long-term, not in short-term, not in long-term. The reason, because interest rates are lower, you will always prefer to invest in the medium-term securities. Now the question is that short-term securities, generally we say from 1 to 3 years, and long term we say mostly over 10 years, and medium we always say between 3 to 10 years. Okay, this is what is American style. The short term bond means a 1 to 3 years bond life, medium means a 3 to 10 years, longer means over 10 years. Is that clear, guys? Okay, now we are discussing one more thing that is called interest rate risk. What is interest rate risk, right? Guys, here is the definition. This is another thing now. Interest rate risk is what? The interest rate risk is the risk that an investment security will fluctuate in value due to changes in interest rate. Okay, I'll just give you example here. For example, assume to understand this concept, let's assume this is the bond market, and let's assume this is the banking market, banking sector. Okay, in bonds market, for example, interest rate is 10%. I can just give you this vague example to explain it. Okay, and for example, if in the now if in this is like bank market means say open market, I would say, or I would say the government. Okay, you can see the government. If for example, or the banking sector, if or the Fed Reserve, central bank, for example, any name you can give, in the bond market rate of interest is 10%. Look, for example, here, if government is offering 10% also. Okay, now what? Doesn't matter for you because you can invest either in the banking or in the bonds, you are getting the same. But this will never happen because bond market always offers more interest rate. Okay, but as a for the sake of example, I'm saying that. Now, for example, what if the bond market, or maybe there's a one bond, not even market, maybe there is a one bond, that bond offers 10% interest, but in the market now, or maybe in the banking sector now, interest rate is 15%. Tell me what will happen. So now see, in the market, interest rate has increased from 10 to 15, but bond is that bond, specific bond is offering only 10% so far. So what will happen now? Look, if you are investor, so you will sell this investment and you will invest into banking. Not only you, everyone will start selling because this bond is giving you less return, and in the bank you can get high return. So in that scenario, what will happen? Everyone will sell this bonds, and bonds market value will go down because everyone is selling. Now look at another example. If bond is offering 10%, but in the market is, for example, 5%. Now what will happen? Or in the banking is 5%. What will happen? People will withdraw the money here because they are just earning 5%. If you got deposit in the bank, you will withdraw the money and you will start investing here. Now look, what will happen? Everyone will start investing, bonds demand will be created, and market value will go up. So, what I'm trying to say, the interest rate risk is that the rate is changing in the market, rate is changing in, for example, market or in banking. Okay, in market, I'll use the word. So, the bonds value is being affected. Not only bonds, even other things can also be affected. So, bonds value will be affected, bonds value will be affected. For example, if the market will increase more interest, if bond is paying less interest, the bonds market value will go down. If the rate in the market has dropped, but bond is offering high interest, so then everyone will invest, bond market value will go up. So this is what is called interest rate risk. I hope that is clear. If you have any question, you can ask, please. Guys, do you have any question?